All right, let's talk about Klarna. In this Talk Tickers Explainer, we're diving into their very first earnings report as a public company, which dropped on November 18th. And wow, did it create a stir. You had this huge disconnect between what management was saying and how the market actually reacted. So let's get right into it. So, on the earnings call, the CEO, Sebastian Siemiatkowski, comes out of the gate just swinging. He calls it their strongest quarter ever. He's painting this picture of a company that is just absolutely firing on all cylinders, a true AI-powered growth machine really hitting its stride. But the market heard a completely different story. The stock got hammered. It was its worst single-day drop since the IPO back in September, plunging over 9%. And it was on huge volume, too. So what on earth happened here?
Well, the confusion really starts with the headline numbers. Because depending on which line item you were looking at, you could build a case that Klarna was either crushing it or, completely falling apart. It was this classic story of beat and miss that really left investors scratching their heads.
Okay, so what's so interesting here is just how contradictory this all is. Look at this. You've got a solid beat on revenue. Great. And a massive beat on their adjusted earnings. That's the non-GAAP number. But then you look at the official accounting result, the GAAP number, and it's a slight miss. And even more important, the company went from a $12 million profit this time last year to a $95 million loss. How does that happen? So let's unpack management's side of the story first. Their whole argument was, hey, look past the weird accounting stuff and focus on what really matters, our explosive growth and the incredible efficiency we're getting from AI. And the absolute star of the show was the United States. Revenue just exploded, rocketing up 51% year over year. For Klarna, this is everything. It's the growth engine, and it's the proof that their huge bet on the world's biggest consumer market is really, really paying off. And this slide right here shows you how they're doing it. It isn't just one thing. Their new Klarna card, it's seeing absolutely massive adoption. Their longer-term loan product, which they call fair financing, is just blowing up. And underneath it all, that core network of consumers and merchants just keeps growing at a really impressive pace. Now this was the mic drop moment on the earnings call. The ability to literally double your revenue while keeping your operating costs almost completely flat, that's the holy grail. It's called operational leverage, and management says it's all thanks to their aggressive push into AI, which has let them grow like crazy without having to hire a ton of new people.
So management's message is pretty simple, right? It's don't get distracted by a little short-term profit swing. We're building an AI-powered digital bank here, and these incredible growth numbers prove that our model is working and it's scaling up perfectly.
But yeah, the market was not buying it, not at all. Investors focused on a completely different story, a story about profits that just vanished and potentially rising risk. So let's break down the market's side of the argument. This is the chart that scared everybody. I mean, look at that swing. Over $100 million from profit to loss in just 1 year. For a company that just went public, a reversal like this is a huge red flag. And it all comes down to one key item on the income statement. And that line item is called provisions for credit losses. The simple way to think about this is it's the company setting money aside today for loans that they think might go bad in the future. It's an upfront cost that hits their profits right away. Okay, so here's why this is so important for Klarna right now. When they issue one of their new fair financing loans, accounting rules say they have to book the entire expected loss for that loan's whole life right up front. But the money they make from that same loan, the interest revenue, that only trickles in month by month. So you can see the problem, right? When growth is accelerating, costs get loaded into the front, and it makes it look like profits are falling off a cliff. And that leads us to the billion-dollar question that has the bulls and the bears totally divided. Is this profitability issue just a temporary, predictable quirk of accounting, exactly like management says it is? Or is it the first warning sign of a real fundamental problem with the quality of their loans? So to figure that out, we can't just look at the past. We have to look forward. And luckily, management didn't just explain what happened. They also gave us a very specific and, I have to say, very bullish outlook for the next quarter. They're guiding for continued strong growth, way above what Wall Street was expecting. But the key number here, the one you've got to watch, is transaction margin dollars, or TMD. Just think of it as their core profit on each transaction. And they're forecasting a huge jump. Their way of proving that, hey, that revenue from all those Q3 loans is finally going to hit the books, and our profitability is going to snap right back. And looking even further out, there are several big things to keep an eye on. A huge new funding deal with Elliott proves they have the cash to keep growing. The Klarna card adoption and new ways to pay like Apple Pay are just feeding that growth engine. But really, it all hinges on that last point. They have to prove that their credit models are good and that the actual loan losses stay stable and predictable. Okay, so that brings us to the final verdict. We've heard the bull case from management, we've heard the bear case from the market. Now it's time for our call. Who really has the right read on this thing? Is this a broken company that just had a splashy IPO? Or is it a truly misunderstood growth story? You know, when we lay it all out like this, a pattern really emerges. The bear case is almost entirely backward-looking. It's all based on sentiment, the gap loss, the high provisions, the stock's fragility. It's all about what just happened. But the bull case? It's all built on tangible forward-looking data, that accelerating growth, the strong guidance, those new strategic partnerships. And for that reason, our reading on Keller is outperform. We think the market seriously overreacted to what is essentially accounting noise, and in doing so, is missing the fundamental acceleration that's happening in the business right now. So here's our prediction for the next earnings call. We think they're going to hit their numbers, especially that all-important TMD target. And when they do, it's going to force a complete shift in the narrative, away from all these credit fears. We think the stock is going to rally as investors are forced to recognize the powerful and profitable growth story that's unfolding here. So the trade idea here is pretty straightforward. We're saying long the common stock. We believe this big post-earnings sell-off has created a really compelling entry point to buy a high-growth, AI-powered fintech leader at a discount. Our target is a move back towards those post-IPO highs, somewhere around $45 a share, as this story gets a lot clearer. And of course, we always have to say, this is not financial advice.